Welcome everyone to today's session, Know Your Numbers. My name's Tim McCarthy and I'm one of the directors here at Sage Business Group, and I'll be your co-presenter today with Michael Osborne, who will introduce shortly. Know Your Numbers is a really important topic because we believe in numbers, and we're going to use Zoom today, so it's a great little tool. If you have any questions that are like on the way through, please pop your questions into the Q&A or the chat, and we're happy to deal with them on the way through. So let's introduce our presenter today, and our key man here is Michael Osborne. Michael's the CEO here at Sage Business Group, and by his very nature as an accountant, he's right into the numbers. So surprise, surprise. Today, Michael's going to lead us though into a real deep dive into some of the key numbers to run a more successful, more profitable, and improved cash flow business. Now, you'll see the difference coming up between profit and cash flow a number of times through the session. And many business owners tell us they're not great with numbers. And whilst that might be true, let's accept that as true. The best business owners either dedicate themselves to educating on numbers, or they put people around them who can dive into these numbers and help them with what's going on. That's Michael's role for our business as a CEO. He looks at our numbers on a monthly basis, and sometimes more often than that, all sorts of numbers, not just financial statements, but critical drivers to the value of our business. So what we're going to hear today is an insight into what Michael looks at for our business, but then perhaps what you can also look for in your business. But either way, whether you're into numbers or not knowing into numbers, knowing numbers is critical to business success. And with that in mind, welcome to Michael today.
Thanks, Tim. Good to be here again. And welcome to everyone. And thanks for giving up the time to come along and have a listen to things that accountants take for granted, I suppose. And hope to be able to turn what we sometimes accountantese, talking in language that only accountants can understand, into something that our listeners can understand. So, okay, looking forward to bringing the session to you. But before we get going, I just want to share a thought with you. Yeah, the budget is not just a collection of numbers, but an expression of our values and aspirations. But have a think about that, because the budget should be there. Your business is there to serve you, so your budget should reflect that. It's not just a collection of numbers that you have to do to satisfy the bank, but it's an expression of what we want to achieve and what we want to get out of the business. So hopefully that means that you've updated your budgets and your forecasts to reflect all the challenges that have been brought upon us recently through COVID-19. These numbers express your aspirations for the business over the next 12 months. And now it's time to make sure you can understand and monitor and measure what you've set in those budgets and forecasts. Hopefully the webinar can demystify a little bit the most common reports you get to see, whether it be on a weekly, monthly, quarterly, or an annual basis. So that you're in control of your business performance if you can understand your numbers. So over the next 45 minutes or so, we'll cover the importance of knowing your numbers. We will look at an overview of the different reports and reports that you should be producing at a minimum. We'll have a look at the difference between profit and cash. We'll also have a look at the key drivers of business value. And then hopefully we can wrap that up and show you how we can adopt best practice. We'll outline some potential next steps for you to take to make sure that you truly understand your numbers. So please make sure you take plenty of notes today. And as I said before, some of this might sound like a bit of a foreign language to you. So if you have any questions, please shoot them through, as Tim said, on the Q&A, the chat line there, and we'll answer them as we go along or at the end. So let's get into it. So knowing your numbers is vital, as it allows you to interpret your reports and to also know if you're on track to achieve the goals that you've set out in your business plan. Now, here are my 6 top reasons as to why I believe you need to know your numbers. Firstly, they tell the story of your business. They allow you to interpret the results of your business activity, the critical drivers and actions you take on a daily basis. Numbers measure the effectiveness of those decisions and actions. Secondly, numbers help you identify symptoms versus root causes. Now, for example, a trading business, a decline in a gross profit is actually a symptom of what could be many root causes, such as ineffective pricing or reworks that are required, or poor purchasing processes and systems, or wastage. From a professional services point of view, if you've seen a drop in new business won, okay, that's the symptom. The root causes could be poor or little marketing, or no sales follow-up, or just simply not asking for referrals. Really important to distinguish between symptoms and root causes. Third reason to know numbers is that they enable you to spot an early warning sign of potential issue. For example, monitoring how long it takes your customers to pay you allows you to quickly respond if that number starts to increase. It gives you the ability to look at the areas of strengths and weaknesses and really highlight those. For example, your balance sheet indicates whether your business value is going up or down. And honestly, your balance sheet actually tells us where your profit's hiding. Really important document. Understanding your numbers. It means you've got more reliable information, more reliable financial information to make your decisions on. And just as importantly, that information is current data, not 12 months old. And finally, knowledge is power. The more you know about your business, the better your business will be. A common theme that we've been reinforcing throughout this webinar series is that your business is there to serve you. So it's imperative that you know and understand your business numbers. So what reports we're going to look at? We'll be reviewing each of these key reports to help you understand what you can learn from each of those. We'll work through an example to show some key learnings and things to look out for in these reports. And we'll do that through this fictitious company, Foods Co, for the examples. First one, trading account. Now, this tracks your sales, your variable costs, your gross profit, and you use that to calculate the return you're achieving before you deduct your fixed overheads. Now, today's session is primarily designed for professional services. So most professional services don't have a trading account, but I'm going to continue on because we do actually have a couple of businesses that trading accounts are very relevant for. And plus, a lot of professional service businesses, whether you be a mortgage broker or insurance broker or something like that, you've got to look at potential clients' profit and loss accounts, and you've got to be able to understand, especially if they've got a trading account. So trading account, your gross profit percentage indicates whether your margins are improving or deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you've got regional locations or, as I said, different product lines, having a trading account for each of those locations or lines allows you to track how each is performing. Small adjustments to the items in your trading account can have a huge impact on the overall results, which we're going to go through now and have a look at. And by the way, we've actually covered quite extensively what impact small adjustments can have on your bottom line in our webinar series titled 7 Ways to Grow Your Business. So you've seen it. If you've missed that one, you can actually go back and rewatch it. So a trading account, let's have a look at an example. Now, here you can see that Food Co has sales of just over $1 million, has cost of sales of about $318,000, which gives them a gross surplus from trading of just under $700,000. Now, in this example, their direct costs were just over $450,000, so that gives them a gross surplus of $248,749. And you can see the gross profit percentage there of 24%. Another way of expressing this gross profit percentage is that for every $1,000 worth of sales this business makes, $240 of that is profit that can be used to fund the overheads of the business. So let's just say this business undertakes maybe some accountability coaching and implements some strategies to increase their customer retention rate. We went through that through the 7 ways. And that results in a 10% increase in sales. Maybe they also work with someone like their accountant to review their stock processes and reduce their cost of sales by 5%. They could possibly renegotiate contracts with their suppliers and maybe result in another, say, 5% saving in their direct costs. As a result of these changes, the gross surplus has increased by over 140,000, and their gross profit percentage has increased from 24 to 35%. Again, for every $1,000 this business puts in the bank, $350 now is profit that can be used to pay overheads. So none of those things that we did there, or the examples, were massive, but that all adds up and have a really big impact on the profitability of this business. That's the trading account. Profit and loss, I'm going to throw over to Tim to take us through a profit and loss account.
Thanks, Michael. So the profit and loss account flows on from the trading account. Sometimes we call it the income statement. Sometimes it's called the statement of financial performance. But essentially, traditionally, it's known as the profit and loss statement. And it shows you all your earnings and your costs over the year, but tracks the overall performance of the business. That's why sometimes it's referred to as a statement of financial performance. What you're doing here is you're matching your income and your expenses for the period, and then you make some adjustments for timing differences. So say, for example, which will come through shortly, sales that have been made, but yet you haven't received the cash yet. So yes, the sale is made and it's part of your profit and loss statement, even if the money hasn't come in. And that is a really critical point, is that it's really important to remember here that profit and cash are not the same. They are very different, and there's reasons for that. We'll talk through them shortly for you. The profit shown on the profit and loss statement does include non-cash expenses. So it includes things like depreciation. And right now, we're seeing some really big depreciation numbers with the addition of special provisions through the tax office in Australia for instant asset write-off. But you must also ensure you have sufficient profit to cover your cash costs, because you can't pay things for profit. You need cash. So things like loan principal repayments, asset purchases, dividends and drawings for directors. The profit and loss statement needs to be covered. The profit needs to cover that. So the profit and loss statement gives you a framework to benchmark your results. Now that's really important, is benchmarking against something, whether that be past performance, whether that be other businesses, whatever it is. Benchmarking helps you know your progress of your business. And you can compare to anything you choose, as long as it's tracking in a way that you can benchmark. Businesses, though, are generally valued by the multiplier of earnings. This is an insight for anyone who's looking to sell their business or grow the business to be sellable. The profit and loss is critical to that value of your business. The profit and loss is the driver of the value. So it's a multiple. Often they take the profit figure and multiply it by a given return, and that's how you get the value of the business. So therefore, if they're both parts of the equation, the higher your earnings, the higher the value of your business. I'm just going to continue now to keep this example going on of Foods Co. to give you an idea of how the profit and loss looks. So we've taken the gross surplus from the trading account and listed all of the expenses, followed by some owner's remuneration down the bottom to calculate the surplus or the loss. As you can see right down the bottom there, the current trading is at a loss of over $113,000. But let's say the company undertakes a review of all their expenses, spends some time, whether it be accounting services, whether it be support services and the like, identifies savings that can be made. Let's just do 2 examples, their insurances and their rent. And so they contact their insurance broker and their landlord, and they negotiate a 5% reduction for both expenses. They just saved $597 on their insurance. They saved $3,000 on their end. But you will notice what we've done. We've been realistic here. You say, let's say you did have to spend some extra money on the accounting or the support that goes with that to break that down, whether it's bookkeeping or the like, and there's an extra cost there. So those fees have actually gone up. But despite that increase in those fees, the overall surplus still has increased from 100 up to 138,000. So it's gone from 24,000 due to 138 up to 138,000 because we're bringing together the trading statement and the profit and loss statement. So now, of course, this leads us to our balance sheet. I'll send back over to you, Michael, to take us through the meaningful part that is the balance sheet.
Yeah, thanks, Tim. And as I mentioned before, that the balance sheet, it's a really critical document. It's sometimes known as a statement of financial position, but it provides a snapshot of your business's financial position at a specific point in time. So it measures the net worth of your business, which essentially is just your assets less your liabilities, or what you own less what you owe. It also shows if your business is solvent or not. If your liabilities are greater than your assets, then the business may be insolvent and an urgent action may need to be taken. Yeah, Tim mentioned before that we've seen quite a lot in the way of instant asset write-off. So we're seeing a lot of businesses with negative, well, with losses, but therefore negative assets as well, but it's a timing issue. So the key takeout here is if you see your balance sheet in a negative position, please just talk to your accountant and they should be able to work through the reasons as to why it's negative. So you can compare different periods to determine whether the business net worth is increasing or decreasing between years. And you can definitely use a balance sheet to track the strength of your business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. The businesses who have in the past who have had strong balance sheets, we know have come through the COVID-19 pandemics a lot better than the ones who were flying by the seat of their pants. It also provides, this balance sheet, a basis to calculate some key ratios that you should be looking at as well, such as debtor days and stock turnover days. So if we go and have a look at Foods Co, this balance sheet, the company is, well, technically insolvent as it's got more liabilities at this present point in time than assets. More importantly, you can drill down and say, look, have a look at the working capital. It's also negative in that current assets are 138,475, but current liabilities are 162,269. Current being the assets being things that can be turned into cash in the next 12 months versus things that have to be paid in the next 12 months. But essentially, it means that this company cannot pay its short-term debts from the limited cash and debtors and stock that's got on hand. An urgent action may be required, and definitely consult your business advisor accountant. It may mean that the business needs an injection of funds of possibly up to $305,000, which is the number you can see down the bottom there. But assuming the company can resolve the solvency issues, there's opportunities for improvement. So over the long term, the company could implement some strategies to reduce their debtor days and their stock days too, to increase cash flow. Now, to calculate debtor days, we simply take debtors, divide that by our sales or our turnover, and multiply by 365. In this actually tells you, on average, how long it takes your customers to pay you. In this example, company's debtor days are 26. So on average, customers pay their bills to you every 26 days. Now, that might be good or it might be bad. If your terms are 45 days, hey, this is great. But if your terms are 7 days, 26 days is not good. It's all relevant. So in this example, if they updated their terms of trade and say requested payment within 7 days, and in doing so, managed to turn this around by 5 days and improve their ratio to 21 days, there's an additional $14,000 that comes into their bank. Cash flow, cash is king. Similarly, if we want to look at stock days, we take our stock or our inventory, we divide that by our cost of sales, which came off our trading statement, and we multiply that by 365. Now, this ratio tells you how long this business holds its stock before selling it. So, in other words, it shows you how long cash is tied up in stock. And in this example, the business turns over their stock every 74 days, roughly. So again, if they were able to review their inventory processes and maybe just reduce the amount of stock they've got on hand, and through better buying processes, they might be able to improve their ratio by 9 days. So this would result in a cash flow boost of around about $7,860. So combined, while the cash flow gains nearly 22 grand doesn't fix a solvency issue itself, it demonstrates that how much cash can be saved with some help from someone understanding these numbers. So if you've got any questions about those reports, maybe throw them down in the Q&A section, but we can answer them now or later on. So moving on, the difference between, and Tim alluded to it before, between profit and cash. And there's a saying that I like, that turnover, it stokes your vanity. Profit, okay, helps your sanity, but cash flow is reality. Now, it's common for business owners to get frustrated when their bank account doesn't seem to reflect their profits. One of the most common questions we get is, Michael, Tim, you telling me that I've got made $100,000 profit? Well, where is it? Because it's not in my bank. Absolutely. We can look at that, look at the balance sheet, and maybe it's sitting in someone else's bank account because they owe you the money. Maybe it's sitting out on your floor in stock. Or maybe it's that brand new car you purchased from cash out of the business. The profit is there somewhere, just a matter of finding it. Now, it's essential that you understand the difference between profit and cash, and why sometimes a high profit doesn't necessarily result in more cash in your bank account. We have seen it happen several times. A profitable business can go out of business because it's starved of cash. Now, similarly, a business running at a loss, it actually can survive, because if it's got access to funds from investors or the shareholders or financiers, it can actually survive tough times. In other words, cash flow is every business's reality. Just to highlight this a little bit more, we're going to go through some items that pop up every day and just determine whether they affect the profit and loss or whether they affect the cash balance. First one we'll look at, GST. Unfortunately, it's a thing we've all got to pay. Now, GST affects your cash balance. It does not affect your profit and loss or get entered in the profit and loss account at all. Loan payments, they affect your cash balance as well, but not your profit and loss. Interest on loan, that actually impacts your profit and loss and your cash balance. When you purchase asset, it tends to only impact your cash balance. Similarly, when you sell an asset, your cash balance. Now, depreciation is another one. That actually only impacts your profit and loss, not your cash. So you can see that even if your business is achieving a healthy profit, there may not be any cash in the bank after paying tax and making loan payments and buying new assets. That's why we get asked that question a lot. You've said I've made a profit, I don't see where. So I want to tie this up a little bit in terms of cash being that every business's reality, and that cycle we spoke about with stock and debtor days. Tim's going to run through something now which is really critical for every business to understand.
Thanks, Michael. With that, we'll jump into what we call the Business 101 cycle. You may have seen us present this before. We sometimes call it the 2-minute MBA. The reason why we call it the 2-minute MBA internally, and I suppose sometimes we've said it to clients, is because this is business in a nutshell. If you ask me, how do I do business on one slide? This is it right here. So hopefully it resonates with everyone on the line. Most people are owners, and therefore it really will apply. So let's look at the Business 101 cycle. First things first, the owners need to invest money, their money, into the business. And so that goes in. What happens with the money? Well, then it gets used to purchase assets to run the business. Now, when we say assets, assets aren't just plant and equipment. They can include people, they can include systems, they can improve technology, new products, all the assets of the business. So an asset can actually be intangible, but that's created through business. But it takes the owner to put their money into business to use these assets. And those assets are used to generate income. Now, sometimes the business may need additional funding to buy those assets. And so we might get a loan for the purchases. We may get further investors. Then we turn those assets, we use them to generate profit. So see straight away, our return on assets is generating our profit. Now, we increase our profit by things like growing our sales or our margins. But then at the same time, we have overhead expenses that drain our profits and they result in a loss if they're not managed. So we've got to be careful of those drains that are going out. Here's the critical point. The profit then gets turned into cash. So we have drains, which Michael just touched on, which include slow payment of collection of debtors, high inventory days, like stocks sitting on the shelf for way too long, loan repayments, tax payments, payments to suppliers. They're all drains that are taking away from that cash. But then there's gains on your cash flow too, which is from collecting the debtors faster, decreasing those days of stock sit on the shelf, negotiating longer terms with our suppliers, reducing our tax, are all really practical ways to create gains from our cash position. Then, from that point in time, the owners take the cash out of the business as their drawings, dividends, repaying the money they're owed, and the remaining cash is then reinvested back into the business so they can purchase more assets and to generate more income. So more assets being more improvements in technology, more people, more systems, more products, whatever that looks like. So they generate more and more to get an increase in the speed. And the quicker we turn this cycle around, the quicker we get the return on assets, the quicker that we generate cash and get returns back to the owner. And that's the aim of business. So we say business 101 or 2-minute MBA, the assets to the profit, to the cash, to the owners, and so the cycle continues. Faster and faster the wheel goes around. That is what we're talking about here to create the business that you want to have. So you've got that in a nutshell, and I'm pretty passionate about that because I think right there now, you can see a really simple one step. How do I actually get my business tracking the way I want to track? But after the cash flow, the business value, it now becomes a really important measure too of business success. Like we've got the business humming along. Let's measure the business value. And part of knowing your numbers is actually understanding and measuring what drives your business value. Now, this is going to be different for each business. Each business is going to have different reasons that will drive business value. In professional services, often artifacts or recurring revenue can be really, really important in driving business value. So some of the things you may want to look at are things like revenue growth per customer, the number of product launches, long-term contracts you've signed, there's jobs that are completed and invoiced, and money collected on that too, and the customers who are paying recurring revenue. So when we talk about critical drivers of business and the business value, we're talking about taking actions to make this happen. You can't just magically launch a product. You actually have to take action to create the product, to build it, to market it, and to launch it. And that's going to add value to your business. So that's where the numbers become really, really important. Understand these numbers, that's great, but then talk about, well, what does it take to actually enhance the business value? We've spent all this time on getting our cycle right. We've got recurring revenue. We've got things going in the right direction. But what are the things that then beyond that enhance the value of the business? And first and foremost, a clear plan makes a big difference. Documented with your organizational structure and those roles within your business, which comes down to a further point further on. We are big believers in cloud-based real-time reporting. Real-time reporting, it allows you to make better decisions, and reviewing and documenting your systems and processes is so much easier and more timely if you have that type of reporting. But it gets the business running as efficiently as possible. We mentioned about the organisation structure and the roles. Part of that is to reduce the reliance on the owners of the business and help to enhance the value, because the less reliant the business is on the owner, the more valuable it is for the potential purchaser or new owners of the business when it's sold. And really important also is identifying and managing risks and managing those risks before they become an issue. Now, we can do a whole session on asset protection and risk management and the like. But just from our point of view, the critical thing here to enhancing business value is just knowing that managing risks is also equally as critical as any other part of having successful, valuable business. So from all that, that's Business 101 in a nutshell in about 4 or 5 minutes. Michael, I might throw back to you and you talk us through what's the best practice for people in business.
Yeah, very good question, Tim. Best practice. So, yeah, I suppose in a nutshell, you're asking, how does everything that we've talked about here this morning come together as best practice? Well, essentially what we believe is that every business should use these 3 essential tools. An annual business plan is number 1. Every business and business owner should have something to aim for. Really critical. I actually saw a quote this morning from Simon Sinek. If you Google him, when we have a clear sense of where we're going, we can be more flexible in how we get there. Really important that, you're actually being regimented to put down a plan, but if you've got focus on that plan, you can actually be a little bit flexible as to how you get there. Great distinction, I thought. Second point, an annual forecast, a cash forecast about just that. If we put things into play, how is that going to impact us cash flow wise, based on that 101 business cycle that Tim went through? And the third part that everyone, I really think is important, having ongoing reporting and some accountability. The reporting ensures that the numbers that you want to achieve are being measured and, I suppose, obtained. This is the ultimate game. The accountability process is just some form of coaching. Using someone independent to hold you to account definitely works. We've said it over and over again. We've done it. We still do it. It works for us. So knowing your numbers is just a beginning, because it allows you to improve on them. And ultimately, if you improve on them, you're going to be closer to achieving your goals for business. So where to from here in these challenging times? Now, our aim is to help you take what you've learnt today and implement some positive change in your business. Now it's time for you to decide what you're going to do. I really want you to take some time after this webinar and write down 3 actions or projects that will add value to your business. Just a little tip, I reckon recognizing and documenting the critical drivers in your business would have to be one of them. If you haven't got a business plan, that would have to be one of them as well. Anyway, but that's what you really need to do, is just take the time out to do that while it's fresh in your mind. Now, what problems are you experiencing in your business? Because that could be something you need to take action on and document and maybe get assistance with. Identify these problems and use them as an opportunity. I said it before. Don't look at it as a negative. Use it as an opportunity for improvement and create a project to fix that issue. Doing nothing right now shouldn't be an option. Another saying we use, hope is not a strategy. So now you know what you should be doing as best practice and in your business, and here's how we can help you. These are just guidelines. We get feedback all the time saying, can you give us some form of idea, please? So, yep, we will indeed. Now, if you don't have a business plan, we can help you develop one. In if you don't have an updated cash flow forecast, one that can be updated on a regular basis, we can help you with that as well. Especially with COVID-19 and some of us are just about to come out, hopefully, and trade, we need to know what impact that's going to have on our business. For some of our retail and hospitality clients, they need to know at what levels it's going to be profitable for them to open. Now, maybe with 10 people, as we're seeing, 10 people in their businesses is not profitable. So what is that number? That's what cash flow forecasting can help you with. Yeah, and performance coaching, that's just a guide there of what would entail, and we could be sitting on your shoulder and assisting you to do all these things you need to do. We know it's difficult to commit to spending money right now, so all of these services include an assessment on how you can improve your profitability and cash flow so that we make it more affordable for you. If you would like, even just, you've given up your time to be here. If you just like a complimentary meeting, catch up and just go over what is possible, give us a call. We'll throw that in for free. If you like a copy of the thing that Tim is very passionate about, you can tell it in his voice, the Business 101 cycle, give us a yell and we can shoot that out to you. So in a nutshell, that's it. I think just wrap up by saying thanks for taking the time out to attend this webinar, and we appreciate your time is very valuable. So if we can help you, fantastic. We hope you've given you plenty of ideas to ponder and also a bit of clarity around the numbers in your business. And they're not there just to satisfy the tax office. You can actually really drive your business a lot further by understanding those numbers. So that's it from me, Tim. I think thanks, Rod, for the comments there. I think that's it for this morning.
Yeah, awesome. Thanks, Michael. So thanks once again. You're always putting so much effort to these sessions, and these sessions I've mentioned a few times on previous ones are designed to help our clients. But it's also to help the public in general, business in general. We're passionate about creating an environment of successful business owners who we work with. And one of the core values for our business is congruency. We practice what we teach. We don't always get it right. We get things wrong. But one thing for sure is we wouldn't be suggesting anything to anyone unless we're doing it ourselves or have already done it for ourselves. So all we're sharing is our thoughts, our where we come from and different perspectives. Thank you, Michael, again for sharing those insights. We really appreciate it. And for anyone out there, please feel free to let people know that these sessions are available, because we are passionate and we're hoping the businesses really come out of these next 12 months. I thought it's been really hard 2 years for businesses, and these next 12 months as we go through a changing environment to see how it can be most successful. So we wish you all the best. Have a great day, and thank you again for being part of Know Your Numbers.